Stocks are rallying across the globe. That includes Europe and the UK. Lindsay Janis joins us now from London, explaining the reasons why. Lindsay.
Good morning, Deidre. European stocks rising for a third day, and they are posting substantial gains this morning. Check out these numbers. We've got the FTSE climbing above 4,000 for the first time in 6 weeks. There's growing speculation that the worst of the global recession may be over. Some investors say the recent economic data shows the pace of the downturn is easing. Some say now's a good time to buy equities because valuations are attractive. Today, a report showed UK house prices unexpectedly rose last month for the first time since October 2007. The average home price in Britain now costs $218,000. That's according to mortgage lender Nationwide. Also, yesterday's offering of 6-year bonds by the UK Treasury drew bids for more than twice the $5 billion in gilts that were offered. Other positive reports include U.S. durable goods orders and home sales rising in February, Chinese urban investment surging for the first 2 months of the year, German investor confidence this month reaching the highest level since July 2007. Also, we've got the ECB poised to cut the cost of borrowing in Europe today. In terms of industry groups on the rise this morning, autos, basic resources, banks, all of these sectors closely tied to the economy. Companies like BHP Billiton, Rio Tinto, Royal Dutch Shell rising. We've also got the takeover, salt maker K+S buying Morton Salt from Dow Chemical, for nearly $1.7 billion. Its shares rising this morning. Swiss Re, the world's #2 reinsurer, plans to cut 10% of jobs within the next year. This after it was forced to post a record loss and turn to Warren Buffett for a cash injection. It's a widespread rally here in Europe today. Now over to Philip Ents in Frankfurt for a preview of that ECB meeting. Philip.
Yeah, Lindsay, thank you very much. We're looking at 50 basis points for the ECB. That's pretty much a done deal, according to analysts and economists that Bloomberg has polled. 55 were questioned by our colleagues over in Bloomberg News, and 49 expect a 50 basis point cut. 4 expect 25, and 2 are holding out and saying, we ain't seeing nothing. So we won't see any cuts. The interesting question really is what is going to happen next? Will the ECB step into the territory of quantitative easing, yes or no, as the Bank of England and also the Fed are already actively engaged in that field? Currently, the situation or the assessment here in Frankfurt is no, they're not going to do it because they already are providing unlimited liquidity via different means into the market, and that is pushing down rates as well. And that also means that the headline figure, the 1.5% that we're currently seeing, and the 1% that we might get later today is probably not that important. Really, the important things are, if we look at effective market rates, they are already at or even below levels that we see in the UK or in the US. If we quickly look at the LIBORs compared to the Euribors, then we see that at the 3-month, the LIBOR in the US is actually lower than the Euribor. But if we look at the 6-month, then it's actually well below. And I can also tell you, it's not on the graphic, but in the UK, both the 3-month and the 6-month are well above the European levels. So there you have it. Interesting rate decision coming up. More now with Eric. Back to you in New York.